Welcome to the GLIO CEO Investor Series. My name is Kyle West, and I manage a listed infrastructure security strategy at Duff Phelps Investment Management. Today we have Dave Hutchens, CEO of Fortis, joining us. I would like to start by thanking GLIO for hosting this event and for all the work it does for the infrastructure asset class. Dave, maybe to help us set the stage for our conversation today, could you share a bit about your background and your journey with Fortis?
Yeah, sure, Kyle. It's not all that interesting of a background because I've been in the sector for 30 years. Other than the first 5 years after college, where I spent as a nuclear submarine officer in the United States Navy, I've been working for utilities. So I started at Tucson Electric Power 30 years ago in some engineering and analyst roles and picked up additional responsibilities along the way. Took in broader pieces of the portfolio. Resource planning is a particular one of note today as we talk about all the things going on from a energy supply perspective. I was actually CEO in 2014 when Fortis bought UNS. Tucson Electric Power is a subsidiary of UNS. And then I had roles at Fortis as executive vice president over a couple of the West Coast utilities in Canada, as well as maintaining my role as CEO of UNS, and then became president COO back in 2020. So that was an interesting time to get promoted to that right before COVID, and more interesting to be appointed the president and CEO of Fortis Inc. in late 2020 to be effective in January of 21. So I've been CEO for almost 5 years here for Fortis.
Thank you, Dave. Maybe just a little company history here. Could you walk us through Fortis's evolution and value proposition, maybe highlighting a few of the key transactions that helped shape it into the diversified utility it is today, and why you feel it provides an opportunity for investors?
Yeah, I think it's important to note how Fortis sort of started. Well, actually, it started where I'm sitting right here, and it's still our headquarters today in St. John's, Newfoundland, as St. John's Electric Light and Power. 140 years and 2 weeks ago, we just celebrated the 140th anniversary of that company. Created a holdco, Fortis, and then grew through acquisitions. And we started in Atlantic Canada, went to the Caribbean, and then out in Western Canada. And two big transactions of note there was picking up the Aquila assets, the electric assets in Alberta and BC from Aquila in 2004. And then another big transaction was picking up Terrason's gas distribution company in 2007 in British Columbia. So that was basically sort of the end of the Canadian acquisitions, and we started shifting to the U.S. And we had pretty rapid fire acquisitions. In 2013, we purchased Central Hudson. In 2014, it was UNS, and that's when I jumped on the Fortis train. And then in 2016 was ITC, and that's basically our last big acquisition, last acquisition of any size, to be frank. And in 2016, we kind of took that pivot and said, you know what, this might be the right time to pivot to organic growth. We definitely have scale. We're diverse enough. You can tell that by looking at the jurisdictions on a North American map. And of course, we had the underlying subsidiaries that would allow us to pivot to that organic growth, particularly some of the larger U.S. utilities as well as the Western Canadian utilities. So that's kind of been our story, and I think it's the proof of looking as to whether or not that pivot made sense. From 2016, from the time that we purchased ITC till the end of this year, if you looked at an average rate base CAGR across that time frame, 6.5%, which is pretty darn good. So it was the right time to do that pivot. And then of course we continue to execute on the other things that are important to our shareholders, and that's things like our dividend growth. And we've been raising our dividend for 52 consecutive years, which is definitely a track record we're very proud of.
Pretty impressive for sure. Thank you, Dave. Investors love to hear about refreshed 5-year plans. So a lot of them coming out this quarter, and you're fresh off of your earnings call this morning. So we'd love to, just have you walk us through some of the key pillars of the updated strategy, particularly around, CapEx priorities and rate-based growth overall.
Yeah, I know investors love to hear it, and we love to talk about it. So it's definitely a good story. We just put out our 5-year capital plan, and we raised it $2.8 billion. So it went from 26 billion. This is all Canadian, unless I say US dollars specifically. All the dollars I'll reference are Canadian. So we went from 26 to $28.8 billion in that capital plan, which that is a $2.8 billion increase and supports a 7% rate base CAGR. Then that compares to the 6.5% rate base CAGR that we had in the prior 5-year plan. So we're very pleased with that. But I think it's even more important and exciting to see the pieces that make up that addition. So it's really in this play, and we can talk later about what the next pieces are. But as we sit here today and look at the growth opportunities in our current portfolio, a lot of them are around transmission. So ITC, our largest subsidiary, and only does transmission. They only do that one thing. They increased their capital plan by $2 billion, and that's through a variety of long-range transmission plan projects that come out of the MISO's process, as well as regular old investments that we make to ensure reliability, and interconnections. Interconnections are a big part of ITC's story currently and on a going forward basis as they look to hook up large load, whether it's data centers, manufacturing, et cetera. The other story I think is on the big part of the story is on UNS. And when you look at what their increases are, it's mostly transmission and distribution. They have about $1 billion of additional capital in this 5-year plan versus the last one. $700 million of that is FERC regulated utilities, FERC regulated transmission, I should say, and the other $300 million is additional distribution infrastructure. So that's all a really good story about that. Good, strong, solid investments that we make in T&D, which is the majority of our company. On the generation side in Arizona, we actually decreased our capital plan, which I'm going to tell you is a great story because we had about $900 million more in the prior capital plan related to gas generation renewables that we found a way to serve that better. So we have a coal generation facility called the Springerville Generating Station in Arizona that we are now repowering from coal to natural gas. So it's a beautiful story from an affordability perspective for our customers. It's got the transmission, it's got the water, it's got the workforce, it's got the great community benefits, and I'm going to say again, it's got a great customer benefit because of the way that we're pulling some of that additional capital out. So even net of that $900 million coming out of the capital plan, we're still up that $2.8 billion. So you got to love a capital plan that grows and has a good, strong affordability story with it as well.
Absolutely. And I think maybe just kind of continuing on to dig in there a little bit further, you mentioned large load growth, large load customers, and data centers certainly in of themselves have become, one of the more prominent kind of thematic drivers, I guess, not only in infrastructure, but in the broader market, right? So,
Yeah.
so maybe, dive in there a little bit more. I'm sure investors would love to hear just where across your portfolio you're seeing the strongest tailwinds, either from data centers or large load customers in general. And how are you kind of positioning yourself to capture that growth?
Yeah, so there's two main jurisdictions that we are really seeing this being quite active. The first is Arizona. And I just mentioned that we pulled $900 million of generation out of the current 5-year plan compared to the last one. Stand by for what's coming next, because we just filed a energy supply agreement with the Arizona Corporation Commission to serve a 300 megawatt data center. And we're able to do that with the existing and planned capacity that we see over the next few years. So they'll be able to come up and basically we'll be ready to serve them as fast as they can without any additional investments within our portfolio. So that's always a good story. But they also want to add another 300 megawatts on that same site. And we're in active negotiations with them on a second site that's anywhere from 500 to 700 megawatts of additional capacity. So that's all the generation that we see on the horizon. When we look at what that means for us and the potential investment opportunities, if we get those contracts finalized, et cetera, we're looking at $1.5 to $2 billion US of additional investment opportunities in just that Arizona, in that Tucson Electric Power footprint. So we are very actively pushing for different opportunities for us to meet that load, looking at how we're going to serve it from a generation portfolio, working with those customers to ensure that we have all the right protections for our broader residential and retail customer base, and making sure that we have credit protections and that we're doing this as smartly as possible. But this is what every utility is doing. But the size of that relative to our portfolio is really impressive. ITC, speaking of size, I mean ITC. So here's the secret. We talk about ITC, but their load growth is driven by the growth in DTE, CMS, and Alliant. So when you hear them talk data centers, we immediately go, okay, what do you need? We're their transmission system. We used to be their those are the assets that we basically pulled out into an independent company years ago. And now whenever they need those transmission, that's us investing behind the scenes. So there's 8,000 megawatts of additional data centers and load growth and economic development in general opportunities there that are spread across ITC's footprint. So we're waiting to see how we're listening as closely to their earnings calls as investors are, because we want to understand how that growth is really coming so that we can prepare for it on the transmission side. Obviously, there's processes that you have to go through, like the long range transmission planning process with MISO on some of them, but that's our investments that are hiding behind there. So we're really excited about what we see in that Midwest footprint.
It's helpful color. Thank you, Dave. Maybe just diving into some of the capital allocation decisions you have to make. Obviously, a large, diversified U.S. and Canadian utility company have both electric and gas assets. I think you're split roughly about 1/3 Canada, 2/3 U.S. on the rate base side, just in round numbers. Correct me if I'm wrong.
That's close enough.
Do you see strategic advantages in being a Canadian company, with significant U.S. investments?
Yeah, because it's a way for Canadian and other investors to get sort of both sides of the border investment opportunities. I think it might be no surprise that we're seeing the U.S. economy grow a little bit faster than the Canadian economy as we sit here today, and has typically been the case. So there is a little bit more opportunities that we see for growth. I mean, especially when you think about the drivers currently in the U.S. administration, when we think about data centers and AI and pushing that forward and trying to get manufacturing and those kind of growth opportunities back in the U.S. That all needs us. Those are all driven by electrons, and that just happens to be what we do for a living. So we're happy to see that driver south of the border, and that gives the Canadian investors, which is still our majority of our investors, are Canadian. And I should mention too that about 1/3 of them are actually retail investors. So those are good long-term investors who are looking for those kind of growth opportunities with the diversified portfolio that we have. I think that's also a very important characteristic is it's not just the growth that we're seeing, but also that low risk that we're seeing. So that risk return is right in the great bucket in my view. The other part of this is on I guess it's north of the border. I would say that's typically what I would say in the U.S. So the Canadian side of things, we are seeing a very strong impetus from the Canadian government to grow their economy. They actually are just putting their budget out today, so I haven't had a chance to read it yet. But they've already been pushing dollars towards getting some large infrastructure projects moving in Canada. They've named 5 out of the gate. They created this major projects office. They're looking at ways of streamlining, permitting, siting. So to me, it's really exciting. I've never seen this where you have both the U.S. and Canada both trying to grow their economies so strongly, and we just happen to be on both sides of that border. So I think in the end we're going to see a bigger part of the world pie in North America, because the U.S. is looking to bring more stuff into the U.S. and build and manufacture more product in the U.S. And Canada is kind of looking to do the same thing, but also spread out globally so they are not necessarily relying solely on one trade partner. So all this means is we're hopefully, on the North American continent and within our footprint, are pulling a larger percentage of global GDP into those regions.
Thank you, Dave. Maybe, just touch on regulation a little bit here, and just maybe some of the key differences between, the Canadian framework and the U.S. framework. Obviously, as a, regulated utility, investor, regulation is certainly extremely important to understand and evaluate, and certainly appreciate how important it is from your seat as well. So maybe talk to us a little bit about the key differences that you see from one side of the border on the other on the regulation side.
Yeah, thankfully, it's mostly the same. It's everyone speaks the same language. When you think about having a regulated construct, those are all the same. There might be some nuances here and there. Like Arizona, we have elected corporation commissioners. Most commissioners of public utility, I would say, in the U.S. and for sure in Canada, are appointed. So it's a little bit different. There's other jurisdictions that have not of ours, but that have elected commissioners. So there is slight difference there. I think overall you will see lower ROEs and equity thickness in Canada, but that's also balanced by much hardier, I'll say, regulatory mechanisms. Whether it's a forward test year. There's a lot of revenue trackers, et cetera. So there's a lot more of the variability and the risk squeezed out in Canada. So that's part of the reason to explain that sort of ROE differential. But however, there's also the bigger picture, which is ROEs authorized, say in Arizona, are not necessarily met because they use a historical test year, right? So you end up with regulatory lag for investments made until you have the next rate case and start recovering on those. So it's a little bit more of a sawtooth earnings curve. And in Canada, even though there's lower ROEs, we tend to out earn them or over earn from an ROE perspective because there's so many additional opportunities for growth, and those regulatory mechanisms are good and consistent.
You alluded earlier to maybe seeing a little bit more growth on the U.S. side versus Canada. So just, from a capital allocation perspective, if you could just kind of dig in a little bit and talk about some of the opportunities you're seeing in Canada, relative to the U.S. And how you kind of approach your capital allocation decisions across the jurisdictions.
Yeah, I would say right now our faster growing utilities are in the U.S. versus Canada. But not by much. I mean, there's still a heap of opportunities up in Canada, specifically in British Columbia, that we think will come to fruition here. So it's not. So I always struggle a tiny bit with whether to call this capital allocation or not, because when you own a regulated utility, you are bound by a regulatory compact with that commission and community and batch of customers. And that is, if we need this stuff, you'll build it for us, right? It's not only that we get to build it, but we have to build it. And so part of that regulatory construct is to provide that safe, affordable, reliable energy for our customers. So what we typically do is develop these capital plans from the ground up on what those customers in each jurisdiction need, and that we know that the regulators are going to support, et cetera. So it is a bit of a ground up view of how we pull those capital plans together. So it's not like we have this finite bucket of money and say, here's the cutoff and you fell below it. We have to maintain those regulatory relationships and the value of those utilities by investing in them. Now, I know I just said all of that, but in the end, we have three utilities that are 70% of our capital plan and our growth, and that's the three biggest: ITC, UNS, and Fortis BC. They also have, as it turns out, the three highest ROE earning potential between ROE and equity thickness, right? So if you did do capital allocation, it's really, that's great to see that it actually started at the top And where we would want to put the most growth is where we're actually seeing the most growth. And of course, when we're looking for things around the edges and additional growth opportunities, we are going to focus on jurisdictions where we know that that's one, affordable for our customers, and two, something that we can get through the regulatory processes.
Thank you. We've certainly seen a lot of headlines in the news and otherwise over the past year or so from a policy and legislative standpoint. Curious, what trends or efforts you're kind of closely tracking in both Canada and the U.S. right now.
Yeah, boy, what aren't we closely tracking, right? It's always fun to open up the paper every morning. There's always something a little different. Like I mentioned, today we're going to open it up and see the Canadian budget being announced. Which, so on the Canada side, with a new administration in Canada, that new government is looking to really boost growth. They've got this Bill C5, which is again pushing those major projects that I mentioned earlier. But it's all about, they're looking at cranking up everything from defense spending to, housing. It's going to be a big, broad economic development push in Canada. And we really are happy to see that. But it's also a large push towards, some energy infrastructure investments, which are part of those big projects that they've already announced. So we're hoping to see that trickle down to our companies, specifically in BC. We've got LNG facilities that we operate out there. There's ones that we can expand. There's a lot of good growth opportunities in BC, and we're going to be the first raising our hands, saying if you're looking to fast track some projects, here's our list, right? So we make sure that we get that in front of the government. So there's also I'll say at least a good, strong, concerted effort to figure out how to do stuff faster in Canada too, right? There's a lot of approvals, permitting, siting, First Nations consultations. All of those things take time. Is there a way to do some of these things a little bit faster and carve some of that time out so that we're not slowing down the growth opportunities as we see them? In the U.S., there's a lot of policy volatility for sure. We're watching FERC closely because it's got two new commissioners. The current administration is definitely got their priorities, and one of them is energy, which is great because that's our business. We're seeing a lot of effort to try to grow the energy sector. I think it's a Department of Energy Dominance Council or something like that, and it's the name says it's all. They're really trying to boost the energy sector in the U.S., but also a heavy emphasis on AI and data centers. So they see that as a strategic imperative, and frankly, almost a strategic defense imperative, the way that it's being couched. There's obviously a little bit of volatility and conversation around what generation they prefer. So, it's kind of all of the above, more all of the above than before, but there's a couple things that, make us a little nervous on, the renewable side of things, because we do think that they, wind and solar have a very important part of the portfolio, and being seen for what they can provide, which is energy and not capacity. But that clean energy should still be a focus. So we're trying to figure out, where that's going to land. And of course, we make long-term decisions and, want to see, where these policies are going to be longer term before we make these, big investments on a short-term basis. And then there's things like the tariffs add a little bit of volatility to the conversation, because, they change quite often. And we still haven't seen much, if any, impact really to date across our portfolio, but we do expect longer term for whatever those tariffs are going to be, they will have some level of impact. And we just want to make sure that whether it's cost, affordability, inflation, the things that impact our customers, that we, completely understand that, but also from a supply chain perspective. Just think the prior conversation about the, call it 900 megawatts of additional generation capacity that we need in Arizona. How long is the queue to get combustion turbines to be able to, start building that stuff out, right? And that's the part that we want to, make sure we're paying attention to. But all in all, I really think that, the tailwinds that we're seeing both on the Canadian side of the border and the U.S. side of the border, which is build, 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 get energy going, and the headwinds, which are really more very, I'll say finely tuned on, the wind and solar push back a little bit. Overall, it's a big, a big tailwind balance.
It's great color, Dave. Thank you. Certainly no shortage of opportunities for you guys at Fortis these days. Increasing that CapEx plan, I feel like almost every time we hear from you. Let's talk about financing a little bit here, and maybe just high level, kind of walk us through, how you plan to finance this kind of robust CapEx portfolio you have, and maybe touch on some of the recent asset sale announcements you guys have put out there as well, and let the audience know if you feel like that could be an avenue to continue to consider going forward.
Yeah, so this is where boring is good. I mean, our financing plan for this 5-year capital plan is exactly the same as it was for the prior one, and we added $2.8 billion of additional capital to the plan. So we're still going to be 59% cash from operations, 30% debt, and 11% equity, and that equity is only coming from our DRIP. So we have an ATM, so we have no discrete issuance is required or desired in that 5-year period. We have a $500 million ATM, sitting there in case we need it, but that's just, that's a buffer. Again, it's not something that we see that we need to fund this new capital plan. And the reasons why we were able to do this was, one, we just issued $750 million of hybrids. And we also just sold Turks and Caicos and our Belize assets. So between those two, we're sitting here in the same spot as we were, with $2.8 billion more of capital in the plan. And yeah, so and by the way, and that's all, and it's credit positive from the last plan as well. So this is all a great story for us. This isn't to be a read through on we're going to be selling a bunch of stuff to fund additional growth on a going forward basis. It just so happened it worked here. Take those two decisions as very discrete and not as a shift in policy of us. I was getting the call or the question on the earnings call this morning on, well, does that mean you're getting rid of CUC, our Caribbean utility in the Caymans? And it's like, no, these are discrete things that we did and now we're done. And our main focus here is, look, we're focused on executing this capital plan and looking at the laundry list of other things that we call above and beyond the plan, and seeing if we can get those into the next plan.
That's great. Thank you. How about the other side of the M&A equation here? Do you foresee any opportunities to grow your business inorganically?
Yeah. So we're not really focused on it, but you can't not pay attention to it, right? I mean, that's sort of, part of your fiduciary duty is look for value, and is there, do things change? And I think the thing that we've learned over the past 4 or 5 years is, oh yeah, things change dramatically at times. And is there an opportunity where a transaction might make sense? Well, you'll never know if you're asleep at the wheel here. You have to make sure that you're monitoring this, and we have plenty of our banker friends keeping us up to date on what's going on and things that. But it's also it's a small universe, right? It's not like it takes a whole heck of a lot of our time to be paying attention. It's not like there's 100 investor-owned utilities like there were when I started 30 years ago. It's a much smaller pool, and then even in a smaller universe that we would be interested in. So it's not tough, but it's also not our focus, right? So this is, again, we got a 5-year capital plan that's going to take every bit of our effort to make sure that we can execute that while simultaneously looking at that above and beyond list and trying to pull those projects in.
It's helpful, Dave. Thank you. Maybe let's talk about executing the plan here. You mentioned, both earlier today with the refresh plan as well as here on the call, that the increase in the rate base CAGR from 6.5% to 7% over the next 5 years. And like I said, almost every time we talk, I get the sense that there are a number of opportunities that present upside to this number. So, what challenges does that present to you as far as the company's ability to execute this plan? And, how are you in the industry as a whole kind of managing these?
Yeah, so there's quite a bit of upside opportunities, and I'll kind of run through a little bit of a laundry list here, just because they're so ripe. This is things, and I would be disappointed, Kyle, if you didn't ask, the day that we announced our 5-year capital plan with that $2.8 billion of additional capital. If your next question wasn't what else you got,
What else
right?
you got?
I mean, yeah, and that's exactly how we look at it, right? It's like, okay, these ones, now let's go get the rest of the rest of this opportunity set. So at ITC, we still have 3.3 to 3.8 billion US of additional investment opportunities beyond the plan, related to tranche 2.1 investments that we've already been allocated through that process. We've got tranche 2.2. I know they're changing the names on these, but basically the next LRTP process step that they're going through and analyzing and trying to define the load growth scenarios and then look at what transmission is needed there. So that's another avenue. There's competitive bid processes going on in Iowa and actually in SPP in some states there as well. The Iowa ones, we're evaluating whether or not we go after those. That's a total. Now this is just a total. I'm just throwing it out there of another 3.7 billion US of transmission projects that are going out for bid. And then of course the 8,000 megawatts of additional data centers and economic development opportunities we're seeing in ITC's footprint. So that's all just in ITC's bucket. Then you kick down to UNS and you have that data center chunk of 1.5 to 2 billion US of generation. You need some transmission with that as well. And then also we're just about to redo our integrated resource plans for both UNS Electric and TEP, which are the two electric utilities under the UNS umbrella. And we're filing those next year, which is going to be another batch of additional projects in there. So while I mentioned we didn't have a whole lot of generation in the existing plan, we expect, over the next few years that we will see that. And again, this is all generation that would be within our regulated utility construct. In Fortis BC, I mentioned the emphasis on major projects on LNG. We just got the news last week that the BCUC approved our Tilbury LNG storage expansion project, which is a 3 BCF tank, and they approved the bigger tank, and we only had a smaller tank in our 5-year capital plan. So that's already, if we get the EA approval of that will already have the ability to add to this next 5-year capital plan. And then there's additional liquefaction for LNG at our Tilbury site for bunkering in a couple of different phases. So when you add all that together, that's a pretty rich opportunity set that we're looking at. Challenges, so far, we've got great people. We've been hiring more. We're going after not just the execution of this plan again, but after that next tranche of projects that we see out there. So the supply chain is going to, like I mentioned on the turbines, is going to be a bit of a TBD on how that plays out over time. I mean, you almost have to go ask for something before you can figure out when you can get it. But we'll make sure that we manage that and manage it within the expectations of what we can do from a company perspective, and what our customer needs. Affordability is going to be a big one, but if you do it right, these growth opportunities will be good for affordability. If you have data centers that plop down and you build the generation and transmission assets that they pay for, and they're also paying for a portion of the rest of the system that's needed to supply them ancillary services and the rest of the support of the grid, they're going to be paying for part of what the other customers are paying for. So in the end, if you do that right, which we are definitely going to do right, and our commission in Arizona will make sure we do this right, as every commission will, you actually have a great affordability story along with that growth. So you don't often get that twofer where you get, wow, can we grow and reduce rates? But this is that time where if you do it right, if you have a vertically integrated utility and can control how those costs and rates are developed with your commission, then it's the best of both worlds.
That's a really good point on affordability, and I think that's something that a lot of people are certainly outside the industry kind of missing right now. So I appreciate the color there.
Yeah, not to get too off topic, but that's because they compare the difference between the deregulated markets, and that are always have an issue with trying to get capacity pricing right. And here you can't necessarily control the price. You can't give them a one-stop shop wrap of a generation, transmission, distribution that's needed for a large new customer. You have to do it in pieces. And if you do it in pieces and create increased demand without the capacity that shows up to supply it, we all know the economics, how that's going to work. And that's, I think, what we're seeing in a couple of those markets.
That's helpful. Thank you. Maybe circling back to regulation here, as we talked about, Fortis, virtually 100% regulated now, and we mentioned how important it is, obviously, from your end as well as our end, to kind of understand what the outlook is. So, on a forward-looking basis here, what's on the horizon for you all? You mentioned, obviously, a very key rate case, in Arizona. Maybe talk through that in a little bit more detail as far as what you're looking for and what could maybe improve kind of the regulatory outlook, both there as well as otherwise, if there's any other rate cases that you want to point out.
Yeah, Arizona's regulation is really constructive right now. So let me start by talking about CH. It was good to get that last rate case in the books a couple months ago. So Central Hudson got that done, and it's a 3-year, it's a forward-looking settlement process. So they're done for 3 years, which is really good to put that check mark. So Arizona's getting quite a bit more constructive. They're pushing for things that we've always been pushing for, which are things like formula rates, which takes out that sawtooth earnings curve that I mentioned prior. And so we have just filed this big rate case for TEP. It's that's again for our historical test year basis. So we've already spent this money. Some of it's, a big chunk of it happens to be battery storage, which is part of our overall resource portfolio diversification and decarbonization efforts that we have down there. So we have a piece of that, and the rest is just all standard T&D and generation type investments. So there's that level of investments, which happens to be $700 million of additional rate base since the last time we filed a case, it's a pretty sizable, but definitely supportable rate increase that we need. So we haven't got the first set of intervenor testimony. That doesn't happen until February next year, and then the hearings will be in April, and we hope to have that case settled by September of next year with rates in effect. So there is a little bit of, because I know you'll want to look at this, Kyle. There's a little bit of a read through on the formula rate, because we did file for formula rates at TEP, and that's the UNS gas case, which it's a very small subsidiary of ours. It's under the UNS umbrella. We've already had the hearings on that. We should have a decision and rates in effect in Q1, but we filed for a formula rate. So importantly, the Arizona Corporation Commission staff is supportive of the formula rates, which I was hoping so, because it was actually a commission policy statement that was trying to push the formula rates. So these are all good signs as a read through that, hey, formula rates are looking good, and if they get approved for our UNS gas, there's probably the likelihood of some version of the same kind of thing being approved for us at TEP. So that's really the main thing that we're watching from a regulatory perspective, and that's going to be I think a very big positive for us, because if we do have some big investments on a going forward basis as part of the integrated resource plans, set aside the ones from the data centers, but just for the rest of the customers, it's a much better way, not just for us to recover costs, but for our customers to get that cost slowly fed back through. But also, if you have a formula rate, if you stuck with the historical test year, you wouldn't get the benefit of increased sales or hotter weather, which it seems to be hot in Arizona quite a bit. So with a formula rate, those sales that are in excess actually end up reducing customers' bills. So that gets pushed back to our customers, especially when you see them coming from data centers. You want to have that sort of live year-to-year credit of what they're doing back on our customers' bills.
It's great. Thank you, Dave. Certainly seems like things continue to progress in the right direction there in Arizona, and we look
Yeah.
forward to kind of monitoring that as we get through some of those key milestones. So appreciate that. Kind of narrowing things down here, closing down here. Taking a step back here. What should long-term investors, infrastructure investors, understand and about Fortis's dividend policy and overall return outlook? You talked a little bit about obviously the longevity of dividend increases at the company, which is certainly impressive. But maybe just provide some additional color and kind of key outlook here.
Yeah, I mean, when you bump up, so you got the two components, right? You got EPS growth and you've got dividend growth, and looking at it from a overall total shareholder return perspective, we're keeping the one nice and steady on the dividend, and we're driving rate base growth to keep the other one, ticking along and going in an upward. Obviously as rate base goes, earnings goes. Supporting not just dividends, but also, getting a better payout ratio and all the rest of that good stuff. So I think from a long-term perspective, if you look at, that rate-based growth I mentioned that goes all the way back to 2016, it's what, for a long-term investor, I always, say, so you just got to follow the bouncing ball. And the bouncing ball is always rate base. Right. Accounting happens, so earnings change. Right. So there's things that cause variability, or the historical test here in Arizona with that earnings curve that goes a little bit like that. Those things, always, chirp around and maybe a little plus or minus from earnings. But the best, overall view is to just look at what's the underlying rate base growth. ROEs might go up, they might go down, they might, equity thicknesses, all that stuff is going to change based on jurisdictions or markets or economy, et cetera. But at the end of the day, follow that rate base growth and showing, our strong level of execution and frankly exceeding our capital plans, on a regular basis. That's the part that I think is most important. That turns into earnings. You got the dividend. That TSR looks phenomenal. And again, we've been doing the dividend increases for 52 years, so it's a pretty darn good track record.
That's great. Thanks, Dave. Last one from me. How do you see Fortis's role evolving in the listed infrastructure space over the next decade?
Yeah, so I really do love that story of the growth on both sides of the border. I think that this is going to be a very interesting spot to be in for the next few years as we see, the battle for who can develop, energy resources and infrastructure faster. I think that's going to be, very good for us. We have all the right pieces, and I think from a growth perspective, we do have strong growth from that laundry list of above and beyond the plan. I think there's, chances of improving it further. And then on the risk side of things, we're getting lower risk in our portfolio almost consistently, whether it's through regulatory mechanisms like in Arizona, whether it's through wildfire legislation in Arizona and the things that we're doing there, whether it's selling a Caribbean asset and Belize assets. I mean, we got a good growth story, we got a good risk story, and we're making them both better. And that's where I think we can see over the next decade that we're going to be very well situated to, definitely execute on some of the opportunities that we see. And I wouldn't, next decade sounds like a long time, but we're utility folks. So next decade is just sort of that midterm, right? It's we put in stuff that lasts 30, 50, 60, 80 years. And so when we look at even, longer term, we see just such a great growth and investment thesis, especially when you look at our specific risk and return.
Thank you, Dave, and really appreciate all your time here on what I'm sure is a busy morning for you. I want to thank GLIO for hosting this event, and I want to thank all the listeners for tuning in to the latest round of the GLIO CEO Investor Series. So thank you all.
Yeah, thanks, Kyle, and thanks to GLIO. It's always a great chance to be able to tell our story to a wide audience, and frankly, it's GLIO is such a great organization because they focus on that critical infrastructure that us and depend on from an investment perspective. But more importantly, this is the critical infrastructure that the economy and society as a whole in the entire world depend on. So it's great to have a good, consistent batch of folks watching that for us all.
Absolutely. Well said. Thanks again, Dave.
Thank you.